We have the RBA decision this week. Of course, we have at least 6 central banks around the world expected to hike rates this week alone. What will move markets?
Well, still, the interest rate policy is going to move market in the very short term because the market is still trying to find its footing in the conflicting news between, rising inflation, which I believe won't bottom out until maybe another 2 months, which means that there will be more rate hikes, and the expectation on aggressive central bank hikes will remain sort of a drag on market. But on the other hand, there's this more recent concern about recession coming in certain big countries, including the US. And then on top of that, you combine the two, inflation plus possibility of recession, there's the concern about stagflation. So all these very confusing trends or issues are being borne out by confusing data as well, which in turn will drive a lot of volatility in the market in the short term. But then we believe that there will be more expectation on hawkish interest rate hikes by the central banks that drive market.
There has been a lot of uncertainty about what China is doing with this COVID-0 policy, but it seems to be easing some of those restrictions. The question of the day for M Live: how far can China assets rally? And this, of course, as we're seeing some of those restrictions lifted. What do you think?
We do need to see China to have a clear exit strategy for its zero COVID policy. Before we see that, before China shows that it's going to do something about exiting that strategy, there will be still a lot more drag on the market than upward momentum. Now, we think for the rest of the year, forget about it. China is not going to change much of the zero COVID policy, but into next year, maybe in the second quarter of next year, there will be more flexibility, and we may have a clearer vision on how China is going to exit that strategy. By that time, there will be a more clear upward trend, because we do believe the Chinese equities will stage a very strong and sustained recovery. The point here is the timing that we don't know, and we're expecting late this year into early next year that we may see that coming.
Where do you see the best opportunities then if we are seeing a bottoming out?
You mean Chinese equities?
That's right.
I think we are bumping along the bottom here, because when you look at the biggest drag on Chinese equities, which was the regulatory tightening on the tech sector, now the worst is over, and we are seeing some tailwind. So that big drag is over. And then there's the easing cycle that China is implementing, which is not finished, despite what the US Fed, what the ECB do. And when you put all this together, liquidity is going to rise in China. The economy hopefully is going to stabilize within the next quarter or two, and then you have the big regulatory drag over now. So it seems that all the stars are aligned for recovery in Chinese equities. As I said earlier, timing is the key here.
Elsewhere around the region, you've got some interesting dynamics when it comes to what central banks are doing. Does the divergence play appeal to you with any of these markets?
We like Asia overall. As compared to developed markets, I think we are overall we are neutral in equities, but we are light on DM markets because of valuation, because of the tightening cycle that the major central banks in the DMs are doing. But over in Asia here, EM overall, we like EM. We like Asia more because the tightening cycle is not going to be as serious as in the US or even in Europe. Because we do have stronger fundamentals here. Current account surplus is bigger this time around for the whole region as compared to last time during the GFC and so on. We have the big player here, China, which is easing, and stabilization and recovery in Chinese economy is going to pull up the whole regional growth and so on. So we like EM Asia more. We are long. Actually, we are prepared to long. EM Asia, we are prepared to long China. Valuation is cheap. We are already long Japanese equities. We don't like much European equities or the US equities at this point. It's a technical decision here because of the valuation and tightening cycle.
When it comes to the FX assumptions, though, is some of that bullishness being driven by the assumption that we've seen the fade in the US dollar and potentially a rebound in the yuan, leading to some more buoyancy for other emerging Asia currencies?
Well, I think short term, we are still going to see more strength in the US than in the regional currencies, including the Chinese yuan. Because, as I said earlier, the short term next month or two, there's still going to be the expectation of hawkish central bank tightening in the developed markets by the Fed. And as long as that expectation exists, while the expectation on the regional currencies and the Chinese policy, which the expectation is that it's going to continue to ease, so that divergence in policy direction will continue to maintain a tight bias for the US dollar and a weak bias for regional currencies, including the Chinese yuan. But then into the fourth quarter, for example, when inflation starts to come down in the developed markets, while things here in China and in Asia starts to stabilize and look up, then there will be more portfolio flow look back to come to Asia and into China again. So by that time, we'll likely see the yuan and some other regional currencies, especially those countries with better fundamentals like current account surplus and fiscal balance and so on, will strengthen later this year against the dollar. So what we are seeing is short term, we are still seeing strong dollar, weak bias for regional currencies in the Chinese yuan. But medium term, going into later this year, we are seeing recovery in the regional currencies, including the Chinese yuan.